I think what is important is to really separate the past and the future. The past was about the enormous cyclical recovery from the pandemic's recession. But the future is really more important to look at the service sector, and the pent-up demand will really come out of the service sector. And what we see is that through the smog that we have at the moment of, inflation fears, we need to navigate and have a clear stance on that. And what we see is simply that these overheating fears are probably exaggerated. First of all, the US economy is already at a very high level. We have seen that also previously with the housing start that you have shown. And also China on a quarter to quarter is much less buoyant than in the past quarters. And Europe, indeed, is really a stepwise recovery. It's a slow burn recovery. So we see sign of moderation when it comes to pent-up demand. On the top of that, we have also the new normal for the job market, for the labor market. That was an argument that was developed by Jeff before, the Siegel argument. There is a new nature of the job market, which will limit also the earnings, the earnings improvement on the labor side. So we see more moderation in the coming months and quarter, and Europe is well positioned for that.
Didier, interesting. We've already seen the European banking subsector of the stock 600 up something like 80% from the third quarter of last year. Given the strength of the rebound we've already seen in some subsectors in Europe, how much more do you think there is to go for here? Look, the DAX is already printing record highs, so it's not as though Europe hasn't enjoyed some outperformance.
Indeed, it's more a continuation of the outperformance that we see in Europe. The banking sector was a laggard for many years, if not a decade. And also the other sector like energy are totally low in terms of valuation because of all the aspects that we have seen of last year with the oil price, but also to the transition towards the new energy. But I think energy, there will be a cyclical uptick, of course, because the demand will mean more energy. But we have also to keep in mind that the long-term trend for energy is more energy. More renewable energy does not mean that we will have less energy consumed in the world. And it will be both in the old energy as well as the new energy. And so we see a continuation of, let's say, the distillation of the momentum into value-based sectors, and Europe is well positioned for that. If you look at the composition of the index, it's still very much focused towards the banking, the energy, the material, and there is still a slow burn recovery in the making, and that will benefit also to the margin of the banks. The yield curve is also steepening. This is good for banks. We see that already in the result. We have seen the first quarter result very good on the banking sector in Europe. There is no reason it will stop.
Is this the right quarter, though, to commit new funds to those sectors? As you've pointed out, it's very noisy at the moment. We're getting a lot of choppy trade. And our own Jim Cramer was making the point that the VIX appears to be signalling further losses or potential weakness through the month of June. So would it be better to wait until the third quarter before perhaps putting new funds into the market?
Obviously, there is a form of a seasonal pattern, but we have to, in investment, delaying action is not good because you may go into the regret curve. When it comes to the VIX, I'm just questioning if the VIX is the right measure to measure risk. VIX has been also pushed down by the central bank activities, by all the action, let's say the volatility containment by the central banks. I think the volatility is more within the sector, and it's really focused in certain area of momentum that we know, the high growth, the pure growth stories, and maybe the VIX is not the right measure to hedge the market. We have to look for, let's say, divergent or a new approach to hedge the risk and the tail risk. the all good diversification is good because you have the value sector into the portfolio, but also exploring what the CTAs has to offer, because they can go short the market, especially for private client. You need to have an instrument in order to hedge the downside.